Hello and welcome back to Explain the Charts, your go-to channel for detailed market analysis. Today is October 5th, 2025, and we are breaking down one of the most traded pairs in the world, the euro versus the US dollar, or EURUSD. The current market sentiment is a mix of uncertainty and anticipation, and we're here to unpack it all for you. First, let's look at the news driving the market. The primary theme is the divergence between the European Central Bank and the U.S. Federal Reserve's monetary policies, which continues to be a major factor. Adding to the complexity is the ongoing U.S. government shutdown, which is weighing on the U.S. dollar and creating a risk-off sentiment in some assets. Analysts are highlighting that while the U.S. economy has shown a strong recovery, Europe's growth signals have been more sluggish. This has led to a fascinating tug-of-war between the two currencies. Furthermore, all eyes are on the upcoming U.S. Consumer Price Index, or CPI data, which will be a pivotal trigger for volatility. A stronger-than-expected inflation reading could bolster the dollar, while a softer number could give the euro wings. Now, let's see how this macroeconomic backdrop is reflected in the charts. Here on the daily chart, we can see the broader story of EURUSD over the past year and a half. After a significant downtrend that bottomed out around the 1.01 mark in early January 2025, the pair staged a very impressive rally for most of this year. This powerful uptrend culminated in a multi-year high of 1.1918 on September 17th. That 1.1918 level is now our key long-term resistance to watch. Since hitting that peak, the price has entered a corrective phase, pulling back over the last few weeks. This pullback found initial support and is now consolidating, which perfectly aligns with the market's current state of indecision we see in the news. The market seems to be catching its breath after a very strong run. Let's zoom in on this more recent price action to get a better perspective. Focusing on the price action from August onwards, you can clearly see the peak at 1.1918 and the subsequent drop. The price has since been trading in a more contained range, primarily between 1.1650 and 1.18. The last few candles show decreased momentum, indicating that both buyers and sellers are hesitant to commit to a direction ahead of major economic data. We've established a clear area of contention. The question on every trader's mind is whether this is a pause before the uptrend continues or the beginning of a deeper correction. To get more clarity on the immediate levels, let's switch to a lower time frame. Switching over to the 1-hour chart, we get a granular view of the current sideways consolidation. This is where the battle lines for the short term are drawn. We can identify a clear resistance zone forming around the 1.1750 to 1.1770 area, which has been tested multiple times in recent days. This level aligns perfectly with the technical analysis from FX Street, which points to it as a significant hurdle. On the downside, we have a strong support area between 1.1710 and 1.1690. This zone has provided a floor for the price during recent dips. As long as the price remains trapped between this support and resistance, we can expect choppy, range-bound trading. This price action is typical of a market waiting for a fundamental catalyst, like the upcoming CPI report or news on the U.S. shutdown. A decisive break outside of this range will likely signal the next short-term directional move. Now, for an even closer look, let's jump to the 15-minute chart for the last trading day. On the 15-minute chart from Friday, October 3rd, we can see the lack of conviction from either bulls or bears. The price action was characterized by small moves up and down, without any sustained momentum. Notice how the price oscillated around the 1.1740 level for much of the day. This reinforces the idea of a market in equilibrium, waiting for new information. Short-term traders would have found this environment challenging, with many false starts. This microview confirms that the larger timeframes are currently in control, and we need to wait for a breakout from the established hourly range. Let's go back to the daily chart to summarize our findings. So, to recap, the EURUSD is at a critical juncture. The long-term trend for 2025 has been bullish, but we are currently in a multi-week pullback from the 1.1918 high. The market is now consolidating, waiting for a catalyst. Here are the key price levels to watch. Immediate resistance is the 1.1750 to 1.1770 zone. A break above this could see the price target 1.1820 and then potentially the 1.1900 psychological level. Immediate support lies at the 1.1710 to 1.1690 area. If this level breaks, the next significant support is down at 1.1640. Now for our unbiased predictions. We have a bullish scenario if the US CPI data comes in softer than expected, or if negative developments arise from the US shutdown, EURUSD could break above 1.1770. This would signal a potential continuation of the broader uptrend. I would place the likelihood of this scenario at around 55% given the underlying strength this year. Then we have the bearish scenario. A strong US CPI print would likely strengthen the dollar and push EURUSD below the 1.1690 support. This would open the door for a deeper correction towards 1.1640 or lower. I see this as a 45% probability, as a significant correction is not out of the question after such a strong run-up. The key thing to watch for is a high-volume breakout on the hourly chart from the current range. That will be your best clue for the market's next intended direction. Thank you for joining us on Explain the Charts. Please remember, this video is for informational purposes only and is not financial advice. Always conduct your own research and analysis before making any investment decisions. Don't forget to like, subscribe, and hit the notification bell for more in-depth chart breakdowns.